Hello, my name is Olav Dirkmaat. We are at Fransisco Marroquín University in Guatemala, and my guest is George Selgin, a leading thinker on money and banking. He's known for questioning the role of central banks and how markets and private enterprise could possibly do better. His books, from the theory of free banking to money free and unfree, have inspired a whole generation of economists. We will also talk about his most recent book, Falls Dawn, The New Deal and the Promise of Recovery, which I urge you to read. He's sharp, honest, and never afraid to challenge the consensus. George Selgin, welcome to Guatemala.
Thank you very much. I'm very pleased to be here.
What's your impression of Guatemala so far? You've been in a few days. It's
Well,
not the first time you're here.
No, it's not the first time. I've been quite a few times, and my impression is it's good old usual self. I've always enjoyed visiting here, but this time I went to Tikal, which I hadn't been to before, and that was extremely impressive. I really enjoyed that a lot, and so this trip has introduced me to an important part of Guatemala and its history that I had not had a chance to observe before.
So before speaking about banking and your new book on the Great Depression and on the New Deal, let me go back way in time to your essay, long essay, which later turned into a book, Praxeology and Understanding, which for me is probably the best summary of the debate on methodology in Austrian economics. So can you give the viewer a little bit of context? Why did you write the article? Why was it so received so well by some Austrians and not so well received by other Austrians?
First of all, I wrote that article sometime around 1982 when I was a graduate student, and I wrote it for a class taught by Fritz Macklep on economic methodology. There's a story there that's a little bit embarrassing because sadly Professor Macklep died before he could finish grading the papers for the class. And they found my paper on his desk with red lines halfway through. And when I presented the paper at the Austrian colloquium at NYU, Israel Kirzner introduced it as the paper that killed Fritz Macklep, which was not really the way I wanted it to be thought of. Anyway, it was an undergraduate exercise, and I wrote it then because I was anxious to defend Misesianism, broadly understood, from what I perceived to be invalid alternatives, revisionist alternatives that were being promoted mostly by NYU faculty. So I was criticizing all the NYU faculty, which was not a smart thing for a graduate student to do. But my opinions then, of course, aren't the same opinions I hold today. I'm less keen on defending any particular methodological approach. I think you learn a lot about the fact that to do actual economics, you need not to confine yourself too much in a methodological straitjacket. Every assignment has its peculiar needs.
It's like a toolbox with different...
That's right. And but at the time, I had these strong views, and I defended them. It is true that some people didn't like them, including the people I was criticizing, and some of the graduate students didn't react too well. But as for the positive reaction, Murray Rothbard read it. He read the paper back then, and he really liked it a lot, and he invited me to his house to talk about it. And so there was both positive and negative reactions. Today, I'm naturally pleased that people are still interested in this graduate school paper that I wrote, but I seldom find myself referring to the arguments in it in my own work. If in fact they have any influence on the work that I do or that I've done since, it's very subconscious. If there is any.
Is praxeology the defining factor of what is an Austrian versus what is not an Austrian? And do you consider in that sense yourself still an Austrian economist in some sense or another?
I don't really, I for some time have disavowed the label because I find it confining, precisely because if you use the label, you have to have some definition of what that means. And almost any definition I could come up with would be one that I would depart from at least occasionally, or I'd like to be able to if I feel the need.
Right.
So not having the label gives me a greater sense of freedom to do any sort of work I like. One of the things I would stress about the essay that I believe in strongly is that for Mises at least, the praxeological approach, it didn't mean that economics was all a priori. It meant that there was a hard core of economic theory that was a priori. Then there was empirical work, which Mises himself was an empirical economist. He didn't do statistics and that sort of thing. He was not keen on many sorts of economic statistics, but he certainly knew history and drew on it. And he called it history. What some economists call empirical economics, Mises called history, which is what empirical economics is, even if it's statistical. And so the wrong lesson, I think, to be drawn from Mises' emphasis on the praxeological nature of economics is that you can be a good economist without knowing and doing economic history. That's not correct. But for Mises, it was important to distinguish the logical, praxeological components of economics, the hardcore, a priori, in his view, part of economics, the foundation for much of all of the theory that's done, from the empirical part that is also extremely important for doing theory beyond the pure logic of choice.
Right. I think you're a great theoretical economist, but you've also definitely a great economic historian, which shows in your most recent book, for instance. And you think this is something that many economists do not have quite right, no? That many economists disregard maybe historical aspects of their own work and as such become, I don't want to say lousy economist, but maybe an economist that's not able to grasp the whole nature of its subject.
Well, I like economic history. I like doing it, first of all. I like both learning about economic history and doing it in the sense of writing economic history, which is telling stories about history and trying to tell the story really well. I like that challenge. As for whether economists neglect economic history or not, of course, many don't. There are plenty of very good economic historians, and they even give Nobel Prizes to them. So it's not
You're
altogether.
referring to Joel Moker and
Yes, most recently, but wasn't that long ago that they gave another prize to an economic historian. And so it's an appreciated field. And a lot of students do econometric research, which, as I said, that's also they're doing economic history. I think, though, that some econometricians don't do enough of the other non-statistical types of history, which is to say, delving more into institutions, archives, that sort of thing, right. Which, of course, is important if you're going to make good use of the statistics that you're massaging with various various econometric models. So I think every economist should ideally be good at econometrics. I'm not. I work with other econometricians when it comes to projects that require it. Ideally, they should know good old-fashioned history and should read it widely concerning especially any particular issues they work on. And, of course, they should master economic theory. Okay. So, which, if you're a Misesian, means knowing something about the a priori part of economics, but it's not important whether we call it that or not. Okay. So I think all of these aspects of the discipline are important. But I want to stress again, no matter how much he stressed a priorism and praxeology, Mises was not somebody who thought that history, empirics in that sense, was anything but an essential part of any good economist's knowledge.
Definitely. So let's go into one specific subject. banking, especially central banking, many people, as well as our students, are grown up with the idea that the central bank is just something that's like has been around forever and will be around forever. You've questioned that, and if we look at the historical record, like the reasons why central banks were brought into this world, have they fulfilled their promise? Has life been better after introduction of central banks, which in human timescales has been rather recently, and not recently in last week, but recently over a span of the centuries now. So, what is your reading about central banks historically and their performance?
Well, first of all, it's true. The vast majority of people, certainly economic students, and sadly faculty, take the existence of central banks for granted and have never even contemplated possible alternatives. And many may assume that they've been around forever, but central banking is mostly a 20th century phenomenon. Before the 20th century, there were not that many countries with central banks. Then there was a period in the 20th century, in the 1920s especially, but also in the post-World War II, post-colonial period, when you had many new nations being established, when the number of central banks grew very, very rapidly, partly as an influence as a result of independence and the notion that every new country should have its own independent currency, but also because by the 1920s, many economists were assuming that a central bank was a vast improvement over any kind of alternative monetary arrangement. But before the 20th century, it wasn't the norm. And so we can look at those past pre-central bank or non-central bank episodes and ask how well they worked. And the answer is that some of them worked very well and had, in many cases, records that a central banker might envy. Now, it's hard to generalize. There are better central banks and worse central banks. I will say that the old systems depended on the gold standard, or some kind of specie standard. It could be silver. But towards the end of the 19th century, the gold standard became the predominant standard for most industrialized countries. And that was once central banks began to proliferate, there was a problem in that I think central banking and the maintenance of any fixed exchange rate arrangement, of which a gold standard is one example, are fundamentally incompatible. Central banks are not reliable for maintaining any kind of fixed exchange rate. Everybody in Latin America doesn't need to be convinced of that, I think. But that was true of the gold standard as well. So inevitably, one of these two institutions had to go. It was either going to be the gold standard or central banks. And of course, we know what happened. So central banking became almost inevitably a pathway towards the modern fiat monetary standards. As for how well central banks have compared, I wrote a study with two co-authors one was from the University of Georgia, Bill Lestraps, and the other one was Lawrence White, who at that time was at George Mason, asking whether the title of the essay was, "Has the Federal Reserve Been a Failure?" And what we meant was, has it achieved the gains it was supposed to achieve?
Right.
We weren't addressing it from the point of view of some standard or goal other than what it is supposed to have done. And the main thing the Federal Reserve was supposed to do was avoid serious business cycles, financial crises. The other things it was expected to do, but originally only with the help of the gold standard, was maintain reasonable price stability, which is still one of its objectives. Finally, we could look at things like financial crises, the stability of the predictability of interest rates, and the extent of unemployment. So we did. Well, what we did was compare the Fed's record to the record of the system that existed before it, which it was supposed to improve upon, which was, by the way, we never say that was a good system, because the pre-Federal Reserve system was a deeply flawed system itself. Without going into the details,
You've written about unit banking, for instance.
Unit banking and the national banking system.
Right.
It was a very flawed currency and banking system. So in no way did I or my co-authors mean to treat it as an ideal. On the contrary, we felt that if we could show that the Federal Reserve hadn't really obviously improved matters compared to that terrible system that preceded it, which it was created to improve upon,
right,
then that surely should qualify as a failure in that sense. It doesn't mean that we could have done better than the Fed, in the sense that it doesn't mean we know there was some obvious better alternative. It just means that it was disappointing compared to what was expected, was that it would...
It was a downgrade from the
already
flawed.
It was at least not obviously better.
Right.
Because the old system was very flawed. We can't say that in every respect the Fed has done worse, but in some respects it certainly has, with respect to maintenance of relatively stable prices. For example, the Fed's record since the transition to fiat money has obviously been poor.
Right.
At least you had long-run price level stability before, even if you had crises. But even with respect to crises and business cycles, the overall record of the Fed has not been much better than that of the preceding system. It's important here to note that some of the old statistics about the pre-Fed era have been superseded. And it's particularly when you use the latest statistics that the supposed improvements of the Fed start to look like no improvements at all. So we've looked at this one case. There are no doubt examples, I suppose there are, of central banks that were better than whatever they replaced. But since the Fed is considered to be one of the better central banks in the world, it's certainly a case study worth considering.
About the business cycles, I remember the former chief of the Federal Reserve, Ben Bernanke, talking about the great moderation, right?
Yes.
The achievements of the central bank of getting rid precisely of the business cycle just before we had probably the most severe crisis after the Great Depression.
That's right. The Great Moderation was one of those periods, an extended period, and perhaps the most important, when the Federal Reserve did appear to be eradicating business cycles. It took quite a long time for it to get around to achieving what it was supposed to achieve from the beginning. We know that the first 20 years of the Federal Reserve was hardly cycle-free. But however, of course, as everybody knows, subsequently, the Great subsequent to Bernanke's remarks, the Great Moderation ended dramatically.
Right.
And we have had a few cyclical ups and downs since, including two very, very serious ones. So the overall record now, compared to the pre-Fed era, is not obviously an improvement in cyclical stability.
The opposite of central banking would be a free banking system, which you talked about.
Well, it would be one alternative, of course. There are many alternatives one can contemplate, but a freer banking system would be one. We have to be careful. What it means to have free banking today is not so clear. Does it mean that we go back to a gold or silver standard at the same time? Strictly speaking, that's a separate reform, right? You don't get that by deregulating banks. Whereas free banking, strictly speaking, just refers to the deregulation of the banking system and the extension of the activities banks can engage in. And also it refers to not having any government guarantees or last resort lending.
We'll talk about deposit insurance, for instance, in a bit, which you talked about in your book. So you've written about the Scottish free banking era, which is 19th century, 18th century, beginning 19th century, as a good example of what a mostly free banking system would look like, even though they had also a metallic standard. Do you still think it's the best example around, like historically, for showing what the potential of a free banking system might be?
Well, first of all, I should give a credit to Larry White again.
Of course. Yeah.
He's the real expert, the one who wrote a whole book about the Scottish banking system, free banking system, whereas I have referred to it in some of my works. I don't think that you can rely very heavily on any one example of relative freedom in banking to draw general conclusions about its consequences, because every example, including Scotland's, involved some very special circumstances, or special departures from strictly unregulated banking and so on. But the Scottish case, nevertheless, is clearly one where most important regulations that we take for granted, including many we take for granted today, were absent. There were no activity restrictions. Banks were free to issue banknotes, except in very small denominations. There were no reserve requirements. Banks could branch freely. Interest rates were regulated by usury laws, but mostly they weren't binding. And there was freedom of entry into the system, although not all banks could have charters. There were also non-chartered banks that competed effectively with chartered banks, and so on. So it's a good example as far as not having many regulations. But there are many others worth looking at. My second favorite is Canada. Canada had also a banking system until World War I, and to some considerable extent until the 1930s, with no central bank and without many regulations that other banking systems had or still have. But it had some important exceptions. Entry into the Canadian system was not free. That is, you had to get a special permission to start a new bank, and that permission got harder and harder to get over time, so that the banking system, even though it involved multiple banks supplying currency, no central bank, before 1935, it became more and more consolidated. And as that happened, Canada became less of an ideal case to study to learn about what true freedom in banking implies.
But Canada has no central bank, a little bit of banking regulation, like
That's right.
restricting entry.
No deposit insurance.
No deposit insurance, which we'll talk about in a bit. I actually stumbled upon an article by Murray Rothbard himself about the myth, he called it, of Scottish free banking. Do you recall that article?
Oh, yes, I do. Larry has answered that article in a separate essay devoted entirely to it, and he took it into account in revising his book on free banking in Britain. So it's an article that has been recognized by the people who think the Scottish banking system is a reasonable approximation of free banking. I think Murray just exaggerates. Of course, it's not a pristine example of free banking. You can point to departures, but they weren't, for the most part, very important. I'll mention one that seems important and deserves attention in a moment. But after all, if we go around saying that things that aren't perfectly free are only mythically free, then pretty soon we'd have to say that free markets are a myth, free trade is a myth. Everything's a myth, because if you try to find a perfect example with no, regulation or no state interference at all, pretty soon you realize that there aren't any. Even in Hong Kong in its heyday, I believe there were some restrictions on trade and government regulations. So there must be more to dismissing an example as not being free banking than merely pointing to the fact that it's not a pure case. Now, Murray made some claims about departures from real freedom in the Scottish system that were simply false. He claimed, for example, that the Scottish bankers relied on the Bank of England for last resort support. There's no evidence that they did, and no reason to think they expected they might rely on it. There was one case only where the Bank of England made an accommodation loan to some very small Scottish banker, but it hardly was substantial or
systemic.
Yeah, it didn't. It was a special case. There was some inside relationship between that banker and some folks at the Bank of England, there was no reason to draw the conclusion from that case that other bankers in Scotland were, pardon the expression, banking on the Bank of England to provide them, to bail them out if they got in trouble. There's just no reason to think that. Now, something very important did happen in the midst of the Scottish rebanking episode that has been treated by Rothbard and others as a departure from free banking. And in some ways, that's not unfair. The French invaded during the Napoleonic Wars. There was an invasion of Wales, actually. It triggered a panic that first affected the Bank of England, which was at that point in trouble because they'd lent so much to the government. And the Bank of England suspended specie payments. Now, because the Scottish economy as a whole and the Scottish banks were dependent on England as a source of gold and for many other things, this put the Scottish banks in a real quandary. If they were going to not become the place that everybody in England went to grab gold, right, they had to suspend as well. And they ultimately decided to do so in sympathy with the British banks, even though in Scotland the courts had not given the banks permission to suspend, whereas in England the Parliament had done so. So the Scottish banks, as it were, suspended with the voluntary, as it were, acquiescence of their customers who could have sued them but didn't. Now, you might say, well, they were afraid to, or they thought they'd lose, or whatever. But the fact of the matter is, and I've written a three-part, that is a very long essay on this, that this decision saved both the banks and their customers, who would have all suffered if the banks had not done what they did. And so it was in the interest of the customers to essentially treat this as an instance of lèse-majesté, that is, an external shock of the sort that makes it impossible for you to honor contracts the way you normally would. And so they went along with the suspension for as long as the Bank of England itself remained suspended. But I think it was a good decision, and if the banking system had done anything else, and again, what it did was not sanctioned by the government. So this is between the banks and their customers. I think if they had, for example, been ordered by the government to keep paying specie, the Scottish or the British government, that would have been an intervention, and one very much not in the interests of those banks and their customers.
Should we call this a bank holiday? And should we talk about like government-imposed bank holidays and maybe some kind of suspension of payment temporarily by banks on their own accord?
Yes, I think that distinction is very important. And I do think the Scottish suspension can be considered as a spontaneous, voluntary arrangement. Even though there may have been some people in Scotland who wanted their gold, all right? We certainly can't say there was nobody. And the banks, by the way, would accommodate during this time certain requests for gold, but that didn't mean that anyone who wanted it, that everyone who wanted it got it. So they tried to discriminate between people who had legitimate need for gold because they wanted to import some goods, for example, and if they could, they would accommodate that person. But we do know that suspensions have non-government suspensions as opposed to enforced bank holidays have occurred in other instances. There were many in the United States. There were several so-called restrictions of payments that the government allowed these to happen, but the government wasn't making them happen. This is in contrast to what the government did in 1933 when they
which you
they
talk about in
closed
your
all
book.
the banks with a holiday, and they did it in a way that was especially harmful because they wouldn't, with the bank holiday, the banks, you couldn't even write a check because you couldn't even make a payment through the banking system, which would just involve the banks, exchanging entries
Which is not
on their books,
withdrawing
not
funds
withdrawing
from the banks.
reserves from the banking system. But in a restriction, or in the Scottish case, what was restricted was withdrawals of actual gold or actual legal tender in the U.S. And but the banks remained open for other kinds of business, including the processing of their banknotes still circulated. So they were all issuing notes, so there was plenty of currency. There was none of the adverse consequences of the bank holiday were in effect in the Scottish restriction of payments, because people could still make payments with banknotes, which were bank IOUs, with transfers of deposits, which were less important. Banks were still making loans. So the banks were not shut down. You just couldn't take any specie out.
Right. So, if well, started about the Great Depression and about the New Deal. Let's talk about your new book, False Dawn, and specifically, just for especially our young students, why should we be interested, very briefly, in this historical episode? Why is it so important, even today, to read about what happened over the course of the government of Roosevelt and the New Deal in the U.S.?
It's a great question, and from one point of view, young students, let's say a student who's 20 or something like that, maybe now we have to go back a little further, but 25. On the one hand, yes, the 1930s is a long time away for them. It's almost a century. And from that point of view, it might seem like it's so far in the past as to not be relevant, so that young people have less reason than others to care what happened then. On the other hand, the younger generations have spent much of their lives in the middle of some kind of financial crisis or economic downturn. And so they have every reason to care about why those things happen and what should be done to prevent them, or at least to make them last to make them not last any longer than is necessary. Well, the Great Depression, because it was the deepest and longest lasting in history, still is, despite these later crises, is a very important case study. Will always, I hope, will always remain the most important case study from which we can draw lessons about what are good things the government can do, what are steps it can take to get out quickly, and what are things that, if it does them, will only make things worse.
Should avoid.
And since the New Deal was famously a set of experiments, right? Roosevelt described it as a policy of bold experimentation. Another way to say that is, he's running a laboratory for us in later generations, including young people, to provide us with results of what happens when you do different things. So it's great from that point of view. Economists, for this reason, macroeconomists especially, they've always treated understanding the Great Depression's causes and also the causes of the recovery as a kind of holy grail of macroeconomic thinking. And no serious student of macroeconomics, particularly in the United States, but I think anywhere in the world, can afford to not be familiar with the history of that episode.
So let me backtrack a little bit. So we take for granted that government has to intervene whenever we have a downturn, an economic downturn, probably very much related to the historical reading of the Great Depression. Especially, let's talk about some myths which are at the beginning of your book, like for instance that the President Hoover was first in charge when the Great Depression occurred, actually was some type of like free market, laissez-faire president who rejected any government intervention in the economy at all. And then Roosevelt took over and brought the New Deal, which was, according to some, a deliberate plan of government intervention, which you say it's more experimentation, it's more improvisation. So yeah, what would you say about this particular myth, that we had a president that first did nothing and then a president that did something that allowed us to get out of the Great Depression?
I want to address the Hoover myth, and I will in a moment, but I also want to step back to your remarks earlier about the alternative of having the government do nothing, which some people say is what Hoover did. Because I don't think that doing nothing was the correct approach to ending the Depression. Not at all. I think the government had to play an active part. But that's true not despite my fondness for free banking, for example, but because of it. And that may seem paradoxical, but I've studied how a banking system ideally should work, and I think free banking systems approximated this ideal, and I wrote about why I think that's true, what the mechanisms are in my first book. And one of the conclusions I drew was that a well-working banking system, which I think a free banking system would tend to be, will keep the flow of spending in an economy stable. Will certainly not allow a massive collapse of spending, such as happened in the early 1930s. Well, in the early 1930s, we didn't have a good banking system. Obviously, we didn't have a free banking system. We had one dominated by the Fed, and the Fed made some very poor mistakes. But mostly these were mistakes of omission. The banking system was bad in other ways, including having thousands of very small, weak banks. And it was a failure of so many banks that caused the American money supply to collapse by almost a third of its value. There's a massive reduction in the amount of money. So when you're faced with these major problems, the major failures of the existing monetary system, then, of course, you're in the world of the second best. If you now say, well, let's do nothing, you're doing nothing in a context where you've already done some things and they've had very bad results. And you don't want to start doing nothing then.
Right.
And so what is doing something? Doing something is having the government take steps, whether it's the Federal Reserve or, if necessary, the fiscal authorities, someone, to try to revive spending again. Because if you're relying on deflation in that circumstance to get the economy back on its feet, it's not going to work very well for all kinds of reasons. The most obvious one being the many outstanding debts that people simply aren't going to be able to pay. So, unless their incomes get back up again. So the government, in these circumstances, had to do something. It couldn't make wave a magic wand and create a sound monetary system that would take care of everything.
Right.
It had to take the flawed system that it had with the bad banks and the Federal Reserve, and working with these flawed materials had to come up with something. And the real criticism I make of the Roosevelt administration is that they didn't take advantage even of those materials to do what they could have done. Hoover, to get finally to your question, Hoover was certainly not a laissez-faire president at all. In fact, many of the more supposedly innovative policies that characterized the New Deal had been anticipated by Hoover, and in some important respects, Hoover was much more active. He was much more active in combating the Depression in the sense that he put more effort into doing the kinds of things that really needed to be done, as opposed to doing things that the Roosevelt administration did that didn't accomplish anything and made things worse. Some of Hoover's policies also made things worse. But let me just mention on the positive side for Hoover, that counters the myth of laissez-faire, but also isn't critical of Hoover. Hoover had been a big advocate throughout the 1920s, perhaps the biggest in government, of counter-cyclical fiscal policy, public works. He was by no means alone among American economists. The government should save up for a rainy day, which is a day when you have a downturn, and then it should spend more. It should do a lot of its spending on various infrastructure or whatever, save up for those times to do the things that you want the government to do anyway, to build the bridges, whatever. He was a big proponent of that. He didn't push hard enough for it as president for all kinds of reasons, mostly the Republican tendency to be against budget deficits. He did, however, run record deficits compared to the past, and he was attacked during the 1932 campaign. He was attacked by Roosevelt for his huge deficits, for his fiscal irresponsibility, because Roosevelt was himself a fiscal conservative. This is another
Right.
part of the myth concerning the difference between the two. Roosevelt was at least as fiscally conservative, if not somewhat more so, than Hoover, and always had been. The other thing Hoover did, and that Roosevelt didn't, was he pushed very hard for the Federal Reserve to engage in open market operations to try to end the Depression or help end it. And which is what Milton Friedman and Anna Schwartz famously say the Federal Reserve didn't do enough. But the only time it really did engage in a substantial round of open market purchases, that is to create more reserves for the banking system to counter the deflation, was under Hoover. On the other hand, Hoover anticipated some bad ideas of the Roosevelt administration, particularly by trying to encourage businesses and labor to businesses to not lower prices, and labor unions and other participants in the labor market to not let wage rates fall, under the false theory that keeping them high artificially was as good as getting them high by boosting demand again. And that was counterproductive. And it became far more so in this New Deal version, the National Recovery Administration.
So one of the government interventions you're very critical of is deposit insurance, in fact. And it was surprising to read in your book that actually Roosevelt was opposed to federal deposit insurance, which we nowadays take for granted. So
Yeah.
how would you...
Well, I have to step back a little bit here too. I'm not that critical of deposit insurance in the following sense. I say that deposit insurance was a factor in stabilizing the banking situation, and that the banking situation had to be stabilized. This is another second best situation. Remember, thousands of banks have failed, and they failed because they're very, very weak. They've been failing throughout the 1920s. So, and that's because they're tiny, most of them, the bank failures are tiny, underdiversified banks. Now, of course, everyone knows that many of these banks are weak. How are you going to get them to put their money back in after the bank holiday? You've got to give people some reason to think that what was a structurally terribly weak banking system is now one you can trust. That wasn't going to be easy in 1933. Deposit insurance was the second best way to, one of the ways to get people to put their money in the banks, which would help recover the economy. So it had long-run adverse consequences, which are the reason why Roosevelt criticized it, and the reason why many economists, myself including, would criticize it as not being an ultimately ideal reform. But Roosevelt was very critical to the point where he did not want it. He opposed the legislation that ultimately created the FDIC until the 11th hour, by which time it was clear to him that opposition would be futile. It was going to go through even if Congress had to override his veto of the legislation to get it through. It was going to happen. So Roosevelt finally conceded, and that's how we got deposit insurance. Here again, the comparison between Roosevelt and Hoover is opposite what many people would assume. Hoover had been, like Roosevelt, a critic of deposit insurance. But towards the end, when the banking system was melting down, he finally said to the Fed, he said, you know, you really need to reconsider deposit insurance, because if you don't do something, we're not going to have a banking system anymore. Whereas Roosevelt never officially changed his mind about deposit insurance. He did take credit for the legislation, but there's nowhere where he says, oh, I was wrong about its long-run moral hazard dangers. And I don't think he ever changed his mind. And he was always reluctant about the actual legislation.
So we're running a little bit out of time, so I'll finish with a quote of your book, and I'll ask you to respond to it. This is especially struck me, this quote, given the fact that we have these discussions right now about central bank independencies, not having government meddling with the central bank. And I was surprised to read what you said about the Great Depression and specifically Roosevelt. You wrote, if ever an administration had control over the Fed and monetary policy more generally, Roosevelt's was it. If monetary policy did less than it might have to end the Great Depression, the Roosevelt administration must bear most of the blame. So can you comment on that section? Because you're basically saying we didn't have a central bank, a Federal Reserve, very independent from government actually during the Great Depression. Is that a correct reading?
Right. It had never, first of all, it had never been all that independent. In some respects, the 1935 legislation that changed the governance of the Fed to what it is today appears to give the Fed more independence. It took the Secretary of the Treasury, for example, and the controller of the currency. Both of them had been ex officio, which is to say non-voting members of the old Federal Reserve Board. Now they're not on there anymore. But it creates the FOMC, which is dominated by federally appointed officials. Including, of course, the chairman of the Federal Reserve, who after this reform, who took part in it, right. He was one of the authors of this 1935 reform. The new chair is Roosevelt's own man. So it's Mariner Eccles is his name. So because of that, you could say that the administration had a lot of influence now on what Eccles and the federal FOMC, what steps they would or wouldn't take to help revive the economy. But Mariner Eccles was a big advocate of fiscal stimulus, but absolutely opposed to monetary stimulus. So if Eccles had been in the Treasury, he might have done more to counter a more counter-cyclical policy. But as Federal Reserve Chairman, his opposition to monetary stimulus was fatal. And that's why, unlike what happened in 1932 under Hoover, the Fed never engaged in any substantial security purchases. If you look at the Federal Reserve's assets, other than gold, which was flowing in from Europe, they are a flat line pretty much throughout the entire New Deal. Just flat.
Well, George, thank you very much for your time. George Selgin will be receiving an honorary doctorate at UFM in one of these days, Friday or Saturday. I thank you for your time, thank you for being in Guatemala, and thank you for watching our conversation.
Thank you, and you're very welcome for my time.